Hey everybody, Smart Silver Stacker here. So we are in the midst of what appears to be a growing financial crisis. It seems like every day we're hearing about some new institution that is threatened by the contagion spreading throughout the banking system. And today I have James Anderson from SD Bullion back on the channel to help us make some sense of what is going on in these markets. So hello, James. Welcome back. Great to have you on. And I am really excited to get your take on this developing financial crisis.
Thanks for having me back on the show. Yeah, some wild weeks it's been. It's absolutely been some wild weeks, and it seems like it's going to get wilder as time goes on. If anyone lived through the global financial crisis of 2008, this really does feel like global financial crisis 2.0. This is the second half that we've often talked about. For years, have been warning about many people who saw that the global financial crisis was essentially halted and covered over, papered over with infinite QE ad infinitum, right? Now we're at the system now. We're at the situation now where it seems like a lot of these regional banks are on a mark-to-market basis. If they have runs on them, are bankrupt. There's like 500 of them. So this is a serious matter, and authorities and people around the world are freaking out. Obviously, they have good reason to. I personally, and I'm not going to name the bank, but I lived for years in Santa Monica. I moved to Santa Monica, California after the global financial crisis, and it was absolutely excellent time. That, if you remember, in 2008, 2009, I enjoyed that time because people were humble. They actually had to get back to work and stop pretending like bubbles everlasting were just the way to wealth. The rent control at this apartment that I rented there was really nice. It was a nice setup. I could walk to work. I mean, I had a quality of life that was pretty sharp. The banks that I chose originally was a mega bank, and then I learned about what bad actors they were, and so I decided to get the hell out of there. And so I started using regional bank, and one of those regional banks is under threat right now because they've mismanaged their business model essentially. So I've been slowly but surely making a run on that. I got to get the hell out of there. I mean, I'll keep it as a side bank if it stays solvent, but I mean, if it gets bailed out or bailed in or whatever you want to do, I mean, if I lose $1,000, whatever, it's the KYC and the AML that's a pain in the ass when it comes to banks, and it's all the information that's inside of it, that bank that makes it convenient for me. So I don't necessarily just want to launch it, but I certainly don't want to leave a lot of currency in there because it could get tied up.
Yeah, it seems like the contagion is a lot more widespread than the powers that be want to acknowledge. One thing that caught my attention was I saw a recent study by the Social Science Research Network, and this study indicated that if half of the uninsured deposits in the US were withdrawn, it would put something like 190 banks at risk of failure, just half. So, one narrative that we've been seeing surrounding this crisis, it seems to be that they want to paint this as a result of poor risk management and bad decisions at banks like SVB and Credit Suisse, but it does seem to be more of a systemic problem. And I want to get your take on what you attribute this crisis to, and how far do you think that this contagion could spread before all is said and done?
All right, so that number that you cited, that was definitely on the Wall Street Journal. I think they reported that a couple of days ago, but I saw in the FT even a couple of days prior to that another report that talked about if SVB failed because of losses alone, more than 500 other banks should have also failed. Right, so you have, I mean, a lot of banks that are on the threshold, and you're asking me. One of the questions that's very important is to know the fear that's out there. And fear is the most powerful of all emotions. It's more powerful than greed. The fear of loss will make you move like that. You will stampede. And so the other thing is with social media and the way that communication travels, it's very quick to get into the lizard brain of human beings, and at scale that you just couldn't fathom prior. I mean, bank runs used to be word of mouth, in a local town, et cetera, and it would just kind of slowly build in momentum. Now it's just boom, instant, lightning flash strike, couple days, digital pull, ACH, bank wire, all digitally done. You don't even have to show up to the bank to do your run. It's a totally different animal. The dominoes, the sequence of this event, I certainly think more banks are going to fail. And it's not a question in my mind. The question is, well, how's the sequence of events going to go?
Last time I had you on the channel, you had forecast that the social media era and the speed with which information can be transmitted these days could really accelerate the pace of any crisis that we face. And I just wanted to point out that that was a very accurate forecast, because that's exactly what we have seen with the collapse of SVB, with Peter Thiel putting out the recommendation that investors withdraw their funds, and then that led within a day basically to the run on the bank. And so I think that that could play a part in this crisis as we move forward, and it could mean that things can collapse a lot faster than back in 2008.
Yeah. Yeah. It's like one of these things, and I've heard people say the analogy before, but if you're in a place where there's a lot of snow, if you're skiing somewhere and, the random snowflake that makes the avalanche occur, or the random movement of snow because of wind that makes the thing break and slide down the hill. I mean, that's basically the kind of concept that you don't know what's going to cause it, but the system is really unstable as it is. I mean, the system and the confidence is starting to go away. And, when you get a bank like that, they were set up for a run that was going to be bad if their customer base, because 97% roughly of their customer base were businesses, big businesses. And so only 3% were just your regular standard run of the mill depositors, right? So if you have the businesses all freaking out and doing a run, between texting one another and messages to one another, we're getting out, oh, we're getting out, oh, I heard this is getting out, I heard that one's getting out. He who panics first wins, essentially, in this type of situation, right? Because if you don't panic and you just stay there and listen to the CEO's pretty letters about how everything's stable in the bank, yeah, you'll be waiting there until they get you a new bank. Good luck. I don't know how fast that'll be. And, oh, I don't know how the website portal will be. And, oh, I don't know about all that information that you need to make it worthwhile to even continue doing business with them. That'll probably all vanish. I mean, these are the kinds of things that you don't think through, but it requires. I just personally think if any business, any enterprise, they need multiple banking systems. They need to have multiple options. You need redundancy in business these days. You need redundancy in your life. If something fails this way, well, what else can you do? You need a backup plan that's maybe not so hyper leveraged to the internet, system working. You need to think in those terms. So, businesses are going to have to start thinking about that in those terms, because right now they're doing some of the dumbest things ever. What they're doing, a lot of these businesses, is just turning around and running into the mega banks because they think, oh, well, they'll get saved because they're critical for the entire infrastructure, so we can just go hide there. Absolutely not. There's an exclusion between 50 billion and 250 billion of regional banks, where the powers that be, Janet Yellen and her friends at the FDIC, they can just, by fiat, decree which bank is, savable and which bank can just go by the wayside. And then the mega banks, there's a G20 bank bail-in law that's still supranational law. The United States and the other G19 countries, the 19 other major countries in the United States, signed this law at the end of 2014 that has not been repealed. So if any of these mega banks, like Credit Suisse, for instance, this past weekend, say they had some bad derivative bets and they blew up and there was a run and they just went to straight up bankruptcy and no one bought them for pennies on the dollar, that would be technically a bail-in, right? That would be, and that could set off a chain reaction, because you have so many counter bank bets that they're trying to insure themselves in case the worst happens. It could just set off a chain reaction. So what we're setting up here is a Titanic of bank failures, and it could be one of these things where it just comes out of nowhere from one random ass lark, or I'm sorry about the language, but it could just be any type of thing. You can't even, when it's done and it's said and done, you'll look back and say, oh, there's no way I could have seen that coming, probably. Or you might think, oh, I could have seen that coming, but chances are no. If you did, you'd probably go around and you'd probably bet on it and make a killing and probably never have to work again if you knew how this was going to go down.
Yeah, absolutely. Well, that is sort of by definition how these black swan events manifest themselves, right, in a completely unpredictable way. And certainly the system is very fragile, and I think it is set up for a collapse at the smallest provocation. Now, speaking of the collapse and the powers that be, Yellen and her pals over at the FDIC, I kind of want to steer the conversation to the response that we're seeing to this crisis from the FDIC and the Fed and the Treasury. And it seems like so far powers that be, when we hear them speak, they want to kind of avoid the bailout word at all costs. You know, they want to insist that none of these interventions are bailouts. It's like become a dirty word. And yet the BTFP program that we saw announced by the Fed, I mean, to me, it seems pretty similar to quantitative easing. I've seen the Fed balance sheet begin to tick back up. I mean, pretty sharp move. I think it's back up to about 8.6 trillion now. Like you mentioned in your latest SD Bullion video update, it's wiping out what, about 4 months of quantitative tightening in about the period of a week. And now I think the latest is that they're talking about maybe officially insuring all of the bank deposits with the FDIC. I mean, that's just the latest rumor. And then in Europe, we've got the
Wait,
UBS
time out.
acquisition.
Wait, what you just said is something that you need to think about, right? If you insure, like we're already at this place because of how much moral bankruptcy we've had and moral hazard we've had since the 2008 GFC. Imagine you would double down. If you think fraud and ridiculous, white collar corruption on the corporate level is bad right now, with derelict of their duties, not doing the right things as far as their charge in terms of taking care of the shareholders. No, they're just going to screw the shareholders. I'm going to get mine. And then once I've got mine, I retire and the thing can blow up. I don't care. I mean, that's essentially the kind of attitude that we've had for the last 15 years. So I just
Absolutely.
need to throw that in there.
Yeah, it's a huge incentive for malinvestment. No doubt about that. It's the
Yeah.
privatization of profits, and then losses are made
Yeah.
public by the
Yep.
taxpayer. And in Europe, it's the same thing. We saw the UBS acquisition of Credit Suisse. It came with these government guarantees in case they, get losses as a result of taking on all these distressed assets. So to me, I mean, it appears to be bailouts. I don't think there's another word for it.
Oh, it's
And
yeah. I
I
mean,
want to get
the
your
Federal
take
Reserve,
on the
the fiat
intervention.
Federal, their balance sheet is running up a wall. That's a bailout. That's infinite QE. I don't care how you define it. They do it in various ways. They're creating currency to save the system. All right. I mean, that's just the way it is. If they're not doing that, if they're not throwing out discount window loans at levels higher than the 2008 GFC peak already, I mean, what is that? Yeah, that's a bailout because those banks would obviously have failed. I mean, that's why they went to get the loans. So yeah, I mean, to get bogged down in like a game of semantics and cat and mouse about what's QE and what's not. I mean, there's like a cottage industry of dorks who do that stuff out there. It's QE. It's running up a wall.
Yes. Okay. Yeah. Well, I tend to agree with you on that, and it's good to hear that. Now, would you say that we're at the Fed pivot? I mean, I know we're going to hear from the FOMC tomorrow. Markets seem to be pricing in a 25 basis point hike. My take on it is even if the Fed does hike 25 basis points, the QE that we're seeing, the expansion of the balance sheet, is far more significant. But does look like possibly a chance that they'll pause the rate hikes. I think if they pause, that's a pretty clear confirmation that we have arrived at a pivot. But even if we get a small rate hike, it seems to be that we may be at that point. What do you think about that?
I think they'll raise it 25 basis points and they'll talk down about inflation and how they have to go after inflation and the system's stable and yada yada. And, just
Yeah.
go back to sleep, America. I mean, basically that's what they'll try and do. Ultimately, some of these banks were just sitting ducks, kind of the way that their models were set up. But there's going to be something else that's going to come along the way. I mean, there's so many catalysts that could possibly come in terms of China and the United States, our relations. I mean, it's just the geopolitical system is so crazy. I mean, if you've been studying geopolitics and if you're a macro investor, I mean, this is like the craziest time of all time. I mean, in your life. So these markets are not normal. This is a totally transitioning world into a system. And so we're going to go through hell and high waters. And in this type of scenario, it's always the same. You want a return of your capital, not necessarily so much worried about return on your capital, because there's going to be a lot of people who are going to get massive haircuts before this is all said and done.
That leads me to my next question. Now, that seems to be a big difference between this crisis and the 2008 financial crisis, the geopolitical backdrop that this is occurring against. I mean, back then, countries like China, Japan, they were buying U.S. treasuries. They were much friendlier to the dollar as the world reserve currency. But now we've got the BRICS actively pursuing a policy of de-dollarization. Sergei Lavrov, the foreign minister of Russia, he mentioned that we might even see a BRICS currency in some nascent form following the BRICS summit in South Africa this August. We've got China cozying up to these Middle Eastern countries like Saudi Arabia, the UAE, and Iran. They just brokered a peace deal between Iran and Saudi Arabia,
Yeah.
and they've got the Belt and Road Initiative, so they're financing all the infrastructure in this country. Their influence is growing, and they are petitioning those countries to price their energy exports, which they happen to be the biggest buyers of, in yuan. So it's a direct threat to the petrodollar system. So, in your view, will this geopolitical backdrop affect the effectiveness of the response that we see to these crises? Will they make QE bailouts, things like that? Are they going to play out differently this time around? And how do you view the geopolitical backdrop affecting this crisis as it plays out?
Yeah, that's a big one right there. That question you just asked. That's a very, very difficult question to answer because the situation, I think you have a little bit of coordination and a little bit of not wanting to work together in certain ways, East versus West. You have a lot of bad blood and bad emotion about what's been going on the last decade or so, in terms of the devolvement of being as close as they once were with us to now being a little bit turning more inward and creating infrastructure that goes over land so that they can trade directly without having to get even on the sea. They can use trains, et cetera, et cetera. So, I mean, I don't know if you've ever seen the map about China and what it looked like around the year 2000 in terms of nations, number one trade export country that they engage with. Well, it used to be almost all blue with a lot of red, in some places for China. But now it's virtually everything except for a couple random Latin American countries that the United States is number one in, and the rest of the world is just pure China. They have a lot of economic power and clout, obviously, and they're going to make a move to get even more powerful, and they're going to get they're definitely going to get more market share in terms of power and sway. The Eastern world is going to evolve. I mean, if you look at the old area where Marco Polo used to travel through, that area is going to see massive growth in the next 20, 30, 40 years. The amount of stuff that's going to happen there is going to change, mankind. I mean, it's going to be historical. So in terms of like the short term, will they coordinate? Will they get along? Yeah, they damn well will have to, because if the banking system is completely failing, they're going to have to, work together to create their next order out of chaos event. And so that next order out of chaos event is going to be the BIS's, CBDC system that they've already worked on. They've already got all these countries in the East working on it. So they're creating, direct immediate payment settlements directly without having to use US dollars as an intermediate currency. That's going to drop down the amount of demand that's, for the US dollar in general. You're going to have countries trading directly with one another, and that's going to make them much more powerful and much less susceptible to what the United States is doing. The United States is having a temper tantrum. When you look at the chart of how many times they're using their old, system for bank wire, et cetera, and how many of these things they're throwing on. I think they threw like 2,500 sanctions last year. And if you look at the charts, it's like straight up a wall. Like it used to be 500 a year, maybe, and 100, a few years back. So it's just like, it's kind of like that same chart of people rescinding their citizenship, just straight up a wall. Like people are done with that. And so, yeah, I mean, to throw a temper tantrum and use a lot of coercion and violence and this and that because you're not going to be the number one hegemon, that's to be expected. That's going to happen, and that's going to continue happening. The United States is going to continue freaking out. But ultimately, we're headed to a more multipolar world. I do still think that the United States will be a major player in the world, but we're not going to be numero uno like we were from post World War II all the way till the early 2000s. Say.
Yeah, I think that, like you said, with the increase in sanctions, I mean, it's pretty short-sighted on the part of our leadership to weaponize the dollar the way it has, because it will be a threat
Yeah,
to the
I
dollar's
mean,
status as the world reserve currency. But it seems like the writing's kind of on the wall as far as that one goes, at
that,
least in the long term.
that's completely why last year, you had the most gold bullion officially bought by government central banks since before World War II, and it's like twice, three times. I mean, the amount that I think it was 1,200 tons. It's like twice the normal, and the normal's been crazy, like high in terms of their net purchases. So, yeah, I mean, something's happening, and the government central banks know that this system is dying and it's on fumes. So yeah, you don't want to be owning huge, IOU, sovereign debt certificate coupons. Those are going to get their face kicked in the decade to come. We had a secular bull market in the United States bond market for like 40 years, 50 years. We'll get ready for a secular bear market that lasts 20, 30 years. I mean, that's going to happen at some point. I mean, they're just going to go full fiat monetization and just straight up buy their own IOUs before it's all said and done. And they'll probably hide them in different places. They'll tell you, oh, it's Cayman Islands. So some investors are buying it. Right. Yeah. I mean, they got like 50 plates going on, and they're just going to tell you whatever they want you to think. It's just going to propagandize you and to keep thinking that there's, having confidence in the system. But in the end, it's arithmetic. It's basic arithmetic. We owe huge untold sums of money, a lot of it to ourselves, but I mean, it is legal. Like legally, we owe a huge amount of unfunded liabilities that are coming due in this decade and into the next. A lot of them increasingly will be, and the only way to fund that is just to burr, to hit the infinite QE buttons, and good luck. Hopefully, in real value terms, it gets you what you need. I mean, if your Social Security check can get you some dog food, good luck.
Absolutely.
That's it.
So, like you mentioned, central banks around the world are buying up gold at a record pace. I think I saw January even is the biggest month over the past year. Like January 2023 surpasses all the months in 2022, and that was a record year. So that seems to be ticking up, and small investors seem to be moving into the gold and silver space as well. I know that over at SD Bullion, you've had perhaps record sales volume, or you're on track to hit that for March. At least the sales volume has ticked up quite a bit. Do you think investors are finally waking up to the need for physical precious metals as a safe haven? What's your current assessment of the physical bullion market here domestically in the U.S.? Where do you see it going?
Yeah, I think what you're having here is the recognition, people recognizing that a lot of the things that we've been hammering on in terms of the issues are starting to play out in front of their face in real time. And so when that happens, what ends up happening is you get real capital inflows, not chump change tube buyers, but you get high net worth investors coming in with 7 to 6 figures, and they just pull trigger, boom, just talking sheer huge volume. Those are the types of accounts that come in when there's real rubber hitting the road. And so that's what's happening. And yeah, I mean, 2/3 of the way into the month, it's already nominally a fiat, in fiat US dollar terms, a record month. So, and that's not merely us. I mean, it's industry wide, and there's a lot of places, local dealers just totally having no inventory and this and that. And I mean, there are other guys out there on the internet who track other websites and all this stuff. So you can just totally see it in the data. But I can internally see the data almost real time. So yeah, it is the realization that, yeah, the rubber's hitting the road and the high net worth inflows that are coming. What I'm still waiting on, and it's coming, is the high net worth inflows of institutional investors. I want to see massive amounts of inflows into GLD, into SLV, into PSLV, into SIVR, maybe. I mean, that thing's horrible, but the bottom line is you're going to see a lot of high net worth investors have to go there because, basically they're by law, essentially, they can't really go out and buy physical bullion given the parameters around the way that they invest. So a lot of times they have to get these unsecured ETFs. But I know there's a lot of people out there who doubt unsecured ETFs, have anything, right? But I mean, when you look at the times when Western inflows jack up into these ETFs, spot price goes up the wall too. So I'm waiting for that as well. India's kind of gone away a little bit in the silver market. I think locally they're at a discount. I think a lot of secondary buyers or secondary sellers are out there in the trading amongst. So there's a lot of liquid silver available still, but at some point that'll dry up too, and they'll be back in the market as well. You could have a situation where India and the Western ETF inflows are both bidding, and that's why SLV, in 2021 basically put an exclusion in their clause saying, hey, if we can't get bars, we can't get bars. Sorry. So what you're going to end up having is SLV is going to be like this totally terrible it's going to be it's an unsecured ETF that will again continue to underperform bullion in terms of bullion will go into premium, it'll go into unobtainium, it'll go into massive high price to get it at certain times. and SLV will just be sitting there completely underperforming as per usual, and you getting the benefit of paying them 50 basis points a year to underperform and have no gold or silver, and have all the risk in your hand, but basically you're an unsecured creditor. That's it. You're basically somebody like at a bank who has way too much currency sitting in that thing, and if it fails, you're kind of screwed. It's the same idea.
Yeah, I think there was that recent story that JP Morgan held some contracts at the LME and
Yeah,
on nickel, and it turned out to just be rocks sitting in a warehouse, bags of rocks. So yeah, who knows what these ETFs have in their warehouses, right?
yeah.
I mean, just further evidence that this could all just be non-existent paper silver, paper gold. But that's pretty much all I have for you today, James. Before we wrap this up, tell everybody where they can hear more from you, and if you've got anything else you'd like to add to finish this conversation up, just please let us know.
Yeah, so I'm pretty active on Twitter. That's I know some people like that social media channel. It's about the only one, that and YouTube. So on Twitter, I'm at James Henry and then on YouTube, I do the channel. I do a weekly update typically for SD Bullion. It's SD Bullion Market Update. I typically drop that on Friday early evening. Sometimes it gets a little late. Now I'm in Central Time, so and when there's heavy news and it's a 20-minute video and there's a lot of lifting and complexity and trying to boil it down into something that I'm not the greatest at that. I could probably make it even more simple, but there's this question of efficiency and speed too, and not screwing up analogies or metaphors. So I try and get as explicit and fast as I can, but it's real time updates with a little bit of opinion and editorialization and trying to make it entertaining too. So yeah, it's a SD Bullion YouTube channel, and yeah, thanks for having me on again. It's a
Yeah,
pleasure to talk.
absolutely, James. I always look forward to your weekly updates, and it seems like probably moving forward, there's going to be even more to cram into those, at least in the relatively near future. Maybe I have to expand it to a longer format with the financial crisis unfolding. But I really appreciate you joining us. Always a pleasure, James. I'll have to have you on again sometime. And take care. Everybody watching, thanks for tuning in. Stay safe and happy stacking. And I will catch you next time. Smart Silver Stacker